Good afternoon, everyone, and welcome back to the Proactive Risk Management for the C-Suite Monthly Series. I'm the host and moderator for today's webinar. And for those of you who don't know me, my name is Chris Martens, and I work with management teams across the country who are looking to increase cash flow, reduce volatility, and ultimately get more control of their insurance programs and employee benefits. Today's topic's a little different. We're going to be focusing on personal risk management, specifically talking about retirement. So let's introduce our very important guest who is very personally and professionally important to me. His name is David McKnight. Why don't you say hi to everybody, David? And just so you know, I've got David's bio. So if he tries to be modest here, I'm probably going to expand a little bit, not in an effort to embarrass him, but it's just so amazing. So David, why don't you talk to us and introduce yourself a little bit?
Thanks, Chris. Appreciate you having me. David McKnight. Been in the financial services industry going on 27 years, which is amazing. It feels like I just started off at MetLife Financial Services in Salt Lake, Utah back in 1997. I've never done anything other than this post-graduating from BYU. So this is all I know. As you mentioned, I wrote The Power Zero back in 2013. Threw it out on Amazon, crossed my fingers, hope people would buy just a copy or two. And here we are 10 years later. And it sort of spawned a mini retirement revolution, I think, just, spreading awareness about the fiscal trajectory of our country and why tax rates, even 10 years from now, could be dramatically higher than they are today, and what 78 million baby boomers can do to shield themselves from the potential for higher taxes down the road. And that book spawned a couple of sequels. You can see over my right shoulder, you can see Tax-Free Income for Life there as well, a couple other books. But yeah, it's been a fun ride, and I enjoy spreading the word and sort of crisscrossing the country, raising the warning cry to people who have huge amounts of their retirement savings sitting on the train tracks with a massive freight train bearing down on them. So that's sort of my story.
Yeah, no, and it's a great story, and it was one that was introduced to me. I'll throw their names out as a kind of a thank you, right? There's a gentleman named Colin Webb, TJ Bell, and Matt Parrick. They introduced me to your book, Power Zero. So it's my obligation kind of do the same thing, and it's really important, not just for the baby boomers, right? This message goes down to the 25-year-old. It's hugely important. To my 14-year-old daughter's chagrin, I talked to her about it, and the kids I coach, they've heard all about this. So it's a message for everybody, really, Dave, in my opinion.
Yeah, I was actually teaching a class I live here in Puerto Rico, so I was teaching a class in Spanish to about 20 or so graduating seniors. Really didn't know much about personal finance, and talking to them about the importance of tax-free accounts. I'll tell you, 20 years from now, start 10 years from now, 2034, the national debt will have grown, just as a matter of course, by $20 trillion. We just received a study out of Penn Wharton that says that if we neither raise taxes nor reduce spending by 2043, the debt will be so big, it'll be 200%. So some experts say that if we get to 175, that could trigger a sort of a financial apocalypse. But by 2043, no combination of raising taxes or reducing spending will arrest the financial collapse of our country. So we're really marching into this future where tax rates are likely to be dramatically higher than they are today. And we sort of have to raise the warning cry so that people recognize that in a rising tax rate environment, there's a mathematically perfect amount of money to have in your taxable and tax deferred buckets. And of course, we can talk about that during the course of the webinar today.
Yeah, and we are going to get to that. I just want to kind of talk about some really quick housekeeping items. We will have time towards the end of the program for questions. When appropriate, please type in your questions, in the question area of the chat panel. We may not get to all the questions today, and if we don't, we're going to look back and try to provide responses to all attendees. And lastly, or one other thing, this webinar is going to be recorded and will be available for replay. So we will have that available to everyone that isn't able to make it in real time here today. And lastly, if we have something today that we discussed that intrigues somebody, and you want to schedule some time to go over additional questions, or you want to dive deeper into a topic, absolutely reach out to me via email, call my cell phone, or send me a direct message on LinkedIn. And David, I think the same thing would apply to you also. I would love nothing than to drive traffic to you. Do you want to mention your website, your YouTube channel? Please take a second or a minute or two to talk about that.
Sure. Advisors that are interested in the Power Zero program can go to powerzero.com. You can learn more about me at davidmcknight.com. And my YouTube channel is entitled Power Zero. We put out 3 videos per week talking about Power Zero strategy, how to debunk the financial gurus' takes on permanent life insurance and annuities, and I also spend quite a bit of time debunking a lot of what we see on TikTok as well, of these advisors who think that, for example, life insurance is the silver bullet. It's the one size fits all financial solution. So I take a very measured, conservative approach to using these types of tools, but it's fun to poke those folks as well.
Yeah, and those are such amazing things that we're going to kind of talk about here. So, as the title suggests, right? The topic is going to be getting to the 0% tax bracket in retirement. Okay. And loaded question, Dave. We'll just kind of start it out here. Is it possible?
Yes, it's possible. Most people don't think it's possible. They think if you're in the 0% tax bracket in retirement, then you must be really, really poor. I remind people all the time that if you have $1 billion, for example, in an IRA, you can convert it all to tax free if you felt inclined. And after tax, what would you have? Maybe $650 million. Well, guess what? If you have $650 million sitting in your tax-free bucket, you can be in the 0% tax bracket. So not only is it possible, but we encourage people to strive towards it, particularly in an environment where we believe tax rates down the road are likely to be much higher than they are today.
Well, you talk about it. To me, this is one of the most important things when I'm talking about to individuals. I'm talking to companies. I'm talking to C-suite executives. A lot of them, right, need or want the ability to be able to model out what their costs are going to be 1 year, 2 year, 5 years, 10 years, right? A lot of time they would love to go out beyond that, but it's not probably feasible in a conversation. But in my opinion, if we are able to tell somebody, if today, if you have $1 million, if you have $10 million in a qualified account, and you are able to do Roth conversions, or if you're able to do Roth contributions, you can absolutely model what that cost is by virtue of income taxes today versus not going to be able to model it out 20 years or so. Would you agree, and talk to us a little bit about that?
Yeah, I mean, it's when we run before and after comparisons for our clients, we always run 3 different projections. The first projection says, hey, if you keep on doing exactly what you're doing, you don't change a thing, and taxes stay about where they are today, you just project that same tax rate out for the rest of your life. How long is your money going to last? We show people how long, when they're going to run out of money. And then we run a second comparison that says, if you keep on doing what you're doing and you don't change a thing and tax rates were to double, like a lot of experts are predicting, how much sooner would you run out of money? And it's plot spoiler here. It's usually 10 to 12 years faster. And then we run a final projection that says, hey, if we can get you at or near the 0% tax bracket, how much longer will your money last? And if your money lasts 5 to 7 years longer, you spend an extra $1.5 million along the way, it's probably worth looking into. So yeah, it's incredibly important to do these types of modeling, because particularly if you believe that tax rates down the road are going to be higher than they are today, you need to know the cost of inaction. You need to know the price tag associated with not taking advantage of today's historically low tax rates.
Well, and I know we've, again, leading up to kind of some of the talk that we had going into today, when we talking about tax rates going up, we've got a period of time right now that is we are pretty certain it's going to change in about 18 months, right? We had the Tax Cut and Jobs Act of 2017, I believe, right? And that the provisions were put in place 2018. Unless something changes, those provisions are going to sunset at the end of 2025. So we do know that there's going to be a change, and talk to us a little bit about that. What can people expect in the next 18 months?
So I'm going to talk about two different groups of people. I got a video coming out about this on my YouTube channel. This is going to surprise a lot of people. Things are not going to change all that much for people in the 24% tax bracket or lower. Let me explain why. If you're currently in the 10% tax bracket now, you're going to be in the 10% tax bracket then. If you're in the 12% tax bracket now, you're going to be in the 15% tax bracket post 2026. And if you're in the 22, you'll be in the 25. If you're in the 24, you're going to be in the 28. So there's going to be tiny changes, on the margins of those tax rates. Now, more importantly, the range of incomes that are governed by those tax rates are also going to be largely the same. They're not going to change all that much. So you'll see that the income brackets are about the same. It's just the number attached to those brackets goes up ever so slightly on the margin. However, if you are in the current 32, 35, or 37, it becomes an absolute bloodbath. That 32, I believe, becomes a 33. The 35 stays the same, and the 37 becomes 39.6. But there's going to be massive tax bracket compression, meaning that you are going to rise through those tax brackets much more quickly than you do under the current regime. I mean, it's going to be really, really nasty. I just did some modeling. If you are at the top of the 35% tax bracket today, I think it's in 2026, it's $730 some odd thousand. In 2026, if they do not extend the tax cuts, you're going to go from an effective tax rate of 22% to an effective tax rate of 30%. That is a massive increase in tax rates on those upper income levels, and it's just staggering. So not a ton is going to change for people in the lower income tax brackets, but they're really going to stick it to people in those upper income tax brackets, which means, hey, there are some planning opportunities between now and then. You've got 2 full tax years to take advantage of historically low tax rates. Now, I don't think you should move heaven and earth to get all your money, for example, converted to Roth IRAs before 2026, particularly if it means you're bumping up into the 32. I think that you should avoid the 32. Why? Because even if you have to stretch your Roth conversion, for example, past 2026, the future version of the 22 and 24 is 25 and 28. That's still lower than 32. So there's no need to reflexively, convert all of your IRAs to Roth and bump up to the 32, 35, or 37. In the meantime, you're just going to be paying much more tax than you really should be paying.
Right. And I gotta, when we're talking about federal income tax here, so we're not even including, if someone lives in a state that has state income taxes, right? So it could get even that much worse for someone in New York, California, some of these states that have high income taxes. And these are my words, not yours. If we're seeing these problems at the federal level, you're seeing them at the state level also, right? You're going to see these same upward pressures on rates. You're going to see these pressures on budgets. I know in the town that I live, we're seeing even property tax increases, which is just another, exposure, right, to somebody in retirement. We don't need to go down that rabbit hole, but there's a lot on the horizon, and no better time to get into motion now. And then just to widen out the lens a little bit further, if people are worried that things are going from, say, 24 to 28 and they're not able to get it in time, let's look at on a historical basis. On a historical basis, we're at the significant low end of historical rates. We're in a golden age right now. Again, my words, not yours. I really think of estate planning and retirement planning. How would you respond to that?
Yeah, I mean, we have this window of opportunity that's closing fast when it comes to taking advantage of historically low tax rates. If you went to Nordstrom and they had a pair of jeans and they said these jeans are going to be half off through Friday, you're probably not going to wait until Saturday, Sunday, or Monday to go buy that pair of jeans. And that's obviously a banal sort of comparison, but it's true. Tax rates are on sale. In my book, The Power of Zero, I talk about the tax sale of a lifetime. We haven't seen tax rates this low since the Bill Clinton era. I talked to David Walker, former Comptroller General of the federal government. I had him on my YouTube channel. I interviewed him and I said, what can you tell me about the future of tax rates? And he says, I can tell you this. I can tell you that tax rates will never in the future be as low as they are today. in his book, Come Back America, this is way back, he wrote this back in 2010. This is before we added, $24 trillion of debt, none of which came from, shoring up the shortfalls in Social Security, Medicare, Medicaid. He said that tax rates have to double by 2030 when you account for federal tax rate, state taxes and local taxes, all of the taxes that need to be raised to bridge our fiscal shortfalls. Tax rates have to double. He says if they don't double by 2030, they're going to have to go even higher every year after that we don't put permanent fixes in place. So if you're talking about retirement planning, you're talking about estate planning, it's only going to get worse from here on out because the debt trajectory only goes up from here on out.
And I always sometimes folks in the insurance world, right? We tend to get kind of this negative connotation thrown on us, right? We're always talking about negative things and bad things. One of the ways I like to we've got a great window of time. We're trying to help people out instead of kicking the can down the road, instead of ignoring. Let's talk about it today. We've got solutions, we've got concepts, we've got these to look after. So this is actually really a positive conversation how I want people to look at it. And I want to just kind of go back to that Penn Wharton study that you kind of mentioned in the beginning of the show here today, right? That talks about the federal rates taxing and so how should these types of studies inform people, and how should they use them? Not to scare them, but when we're talking about retirement planning strategies, how should they factor these in?
Well, a lot of people think that the federal government has the ability to simply kick the can down the road forever, and so they continue to procrastinate things like Roth conversions and things like that. But we know, based on the study, that there comes a point in time beyond which the federal government can no longer kick the can down the road. They have to put permanent solutions in place. Now, the study said something interesting. They said that when you get to 200% debt to GDP, that happens in 2043, then, like I said, there's no arresting the financial collapse of our country. There's nothing you can do at that point that will arrest the financial collapse. No combination of raising taxes or reducing spending. Like the debt spiral will be irreversible at that point. But they also said something interesting. They said that definitely happens when you get to the 200% of debt to GDP. But they also said it could also begin to happen when the debt to GDP gets to 175%. That's the danger zone. And that could happen a couple of years earlier. And so I think that, how should this inform the types of decisions you make about retirement planning? You have to recognize that there is a window within which the federal government has to act. And every year that they don't act, that window begins to shrink. And you can expect that tax rates will have to rise within that window. And so every year that goes by where they are like extending tax cuts or not putting higher tax plates or permanent cuts in spending in place makes the reality of higher taxes all the more real, all the more inevitable. And the fix on the back end is going to be all the more aggressive. And who's going to pay for that fix? Well, it's going to be everyday Americans like you and me who worked hard and played by the rules and saved where we've been told to save. And, currently 95% of the cumulative retirement savings of Americans all across the country are in 401ks and IRAs, sitting on the train tracks with a massive freight train bearing down on. Only 5% are in Roth IRAs, Roth 401ks, those types of accounts. And so how should this inform our decisions? I think it should play a pretty prominent role in informing the timing of Roth conversions and the types of accounts that we're currently contributing to when it comes to saving for retirement.
And I just want to kind of interject here a little bit, just on a personal note. And I always, the way that I run my practice is I would never recommend to anybody to do something that I wouldn't do myself. And I got to tell you, David, as I said in the beginning of the show, having you on a guest, it was personally and professionally important to me. After I read your book, Power of Zero, probably about 2 years ago, I made some changes. And one of them was to change, contributions into a Roth 401k. I started doing the changes. Did I do a wholesale change? No, but I made changes. I'm doing it myself. I would never do it to, have to ask somebody else to do it if I didn't do it myself. But you made a comment just before when you talk about everyday Americans, right? And probably the ones that are most at risk. And I think, unfortunately, there are some folks out there that have garnered probably some quite large followings, right? And I worry that their very rigid, very narrow messaging might put some folks in a bad place down the road. And I'm not saying everything they say is bad, but you do have some people, you've got Dave Ramsey, right? And his poor employee, George Kamel, got himself in a little bit of a pickle. I don't know if that was a few months ago or last year, but you've got Dave Ramsey talking about an 8% distribution rule for retirees and pre-retirees. We got to kind of go down this rabbit hole a little bit, David, for those aren't familiar. But what's the danger in using an 8% distribution rule for folks who might be following the advice?
There's a couple of dangers. First, okay, why is Dave Ramsey saying you can draw 8%? It's not because he has some study that he's citing that says that 8% works. He says because if you use a lower rate, you are going to steal hope from a broad swath of Americans. Why does that steal hope? Here's why. If you need, say, $80,000 per year to live in retirement, adjusted every year for inflation, and you have to live by the widely accepted 4% rule, how much money do you have to save by the time you retire? Retire by day one of retirement, you got to save $2 million. 4% of 2 million is 80,000. This is a pretty big number for Dave Ramsey's listeners. In fact, if he were to tell his people over the airwaves, you've got to have a reasonable hope of being able to retire independent of friends, family, and the federal government, you need to save $2 million by the day one of retirement. Most people are going to be so discouraged by this that they won't even make the first move off of square one towards financial independence. However, if he says, you can sustainably live on 8% withdrawal rates, and you need 80,000 per year, then you only have to save $1 million, only half as much. That's much more realistic for people who are starting at zero. The number is much smaller. Here's a problem with all of that. The first problem is under the 8% distribution rate, people are only saving enough money to be able to accumulate $1 million. So they're not saving enough. Okay, maybe they could be saving more, but they're not because Dave Ramsey told them they don't need to save $1,000 a month. Maybe they only need to save $500 a month. So that's the first problem. People aren't saving enough. The second problem is when people do hit retirement with that $1 million and they're spending 8% of that $1 million, there's like something on the order of a 65% likelihood that they're going to run out of money far in advance of life expectancy, which means they're going to go broke and have to sort of eke out an existence on, subsisting on Social Security alone. This is what I call the Dave Ramsey circle of poverty. He gets people out of debt by preaching, I think, correct principles of living within your means, helps them build a nest egg. And then once they have that nest egg built, he encourages them to take 8% distributions, which forces them to run out of money and they end up in poverty again. So it's this weird combination of strategies that he's telling people. He's great at getting people out of debt and building a nest egg. But then once they're there, he's giving them crazy, irrational advice on how to spend that money in retirement. And so a lot of people are going to get to financial independence and they're going to spend all the money based on 8% withdrawal rates and run out of money before they die. And that's frankly what most people are afraid of doing, running out of money before they run out of life.
Well, let me ask you another way. Let me ask you this another way. Is there a way to safely take out 8%, right? If Dave Ramsey's saying 8% is fine, is there a way to maybe take out 8%? Is there a different way to do it, right?
Yeah, and yes, there is. And the irony of it is that the only way to really do it is to utilize financial instruments that Dave Ramsey categorically rejects. Okay. So this is how ironic this whole scenario is. To get 8%, like Dave Ramsey tells you, you have to utilize financial tools that are verboten in the Dave Ramsey vocabulary, right? What are we talking about? Well, if you're younger than, say, 50 or so, you can avail yourself of a strategy that utilizes cash value life insurance. Okay. So basically, it's a volatility buffer or volatility shield strategy that I outline in my book, The Volatility Shield. And the idea is that if you can save 3 to 5 years worth of living expenses within the cash value of your life insurance, Then in the first 10 years of retirement, and this is by day one of retirement, by the way, and then the first 10 years of retirement, in the year following a down year of the market, you pay for your living expenses out of your cash value life insurance. What that does is it gives your stock market portfolio a chance to recover before you take further distributions. Remember, the reason why you can only take out 4% per year, according to, mainstream financial planning community, is because you have to take that 4% out rain or shine when this market is up or down. When you take it out when it's down, it sort of eats away at the worker dollars that are supposed to be producing that income over the course of retirement. And so 4% is what you are able to sustainably withdraw, and it's because of those down years in the market, particularly in the first 10 years of the market.
Yeah.
If you can allow your stock market portfolio to recover before you take distributions, because you're living out of your cash value life insurance, then all of a sudden your sustainable withdrawal rate starts to skyrocket. It's no longer 4%. I've done hundreds of thousands of Monte Carlo scenarios on this. It can actually go as high as 8%. So by utilizing cash value life insurance, something that Dave Ramsey calls, so he says that 100% of cash value life insurance sucks 100% of the time. Okay. It's a steaming hot pile of garbage. The only people that do it is because they're dupes or they haven't researched it enough. If he were to actually research it enough, he would find that by accumulating 3 to 5 years worth of living expenses in your cash value life insurance, you can actually take 8% sustainable withdrawals. Okay. That's the first way. And it's usually one that I recommend for people that are younger than 50. The one that I recommend for people that are older than 50 is simply using an annuity. And I always tell people, if you don't like annuities, if that's a 4-letter word for you, then you're certainly not going to like Social Security or that company pension that you plan on receiving, but those both operate by the same risk pooling rules and principles that annuities operate by. So annuities allow you to do two things that the stock market approach doesn't allow you to do. And when I say stock market approach, I'm talking about the 4% rule. Build up a huge pile of money and then constrain yourself to a little tiny, 4% distribution rate over retirement. Annuities allow you to do two things. Number one, you can get a guarantee that you'll never run out of money so long as you're on the side of the grass. And the second thing is you can get that same sustainable distribution, safe, sustainable lifetime income for much less money than the 4% rule. Remember, we said, okay, if you want $80,000 per year, you got to spend $2 million. You got to have $2 million saved by day one of retirement. Well, guess what? If you can utilize an annuity, you can get that same $80,000, even adjusted for inflation, for much less money than $2 million, maybe closer to say $1.2 million. And guess what? That frees up $800,000 that you can then utilize to do some really interesting things like long-term care, LIRP, cash value life insurance, a discretionary fund to help pay for that trip around the world or repair the hole in the roof, what have you. So it's just, if you could simply open yourself up to utilizing some of these financial tools that, by the way, academia has done, reams and reams of study on and sort of corroborated the mathematical benefits of, all of a sudden you can have a lot more options and spend more money and have some guarantees that money will last as long as you do.
I couldn't help but you probably saw me smiling and laughing a little bit as you're talking, because it's just it's pretty darn ironic. And I don't want to make it sound like I'm talking negatively about anybody, but we do have, we've got Dave Ramsey, who right calls permanent life insurance cash value life insurance what he calls it, right? You've got Ken Fisher, who rails against annuities ad nauseum. You've got Susie Orman, who again talks about, buy term and invest the difference. I can't help but go back to another study, right? There's one that came out recently, a very compelling study by Ernst & Young. And I have it up on another screen here, but they talked about, I think it was about 4 or 5 different methodologies or scenarios, right? And one was invest only, right? Just straight up investing in markets and the probability of success. The second one was term life plus investments, buy term and invest the difference, right? One was permanent life insurance plus investments. One was a certain type of annuity plus investments plus insurance. And the last one was permanent life insurance, annuities plus investments. and they looked at different scenarios for a 25-year-old couple, a 35 and a 45-year-old couple. And Dave, you probably know the findings of the study, but what were the results, and what was the best combination? What yielded the best probability of success?
Yeah, so if memory serves, and by the way, people should recognize that it's not about, and Tom Hegna talks about this all the time, it's not about assets and retirement, it's about income. It's about what sort of income your assets can produce. Um, and so what the study was really measuring was what combination of alternatives will give you the most sustainable income in retirement. And surprisingly, this study really surprised a lot of people. The combination of alternatives that gave the most sustainable income and even actually passed the most money on to heirs was 30% of your retirement savings going into cash value life insurance. By the way, if you look at the footnote, why was cash value life insurance so important? Because they were using the volatility buffer concept. In a year following a down year in the market, they were paying for living expenses out of the cash value life insurance, allowing those stock market assets an opportunity to recover before taking further distributions. And so that's why that was so important. So 30% of cash value life insurance, 30% into annuities, and then the balance going into stock market portfolio. And so this is why I tell people all the time, especially those that are younger, put 30% of your retirement savings, money that you would otherwise earmark towards retirement, into cash value life insurance. And what you'll find is even though less money is now going towards your 401k, you'll have a lower balance in retirement in that 401k. You'll be able to take a larger sustainable distribution in retirement, as high as 8%. So let's say instead of accumulating $2 million because you're putting money into the cash value life insurance, you're now only accumulating, say, $1.3 million. Well, guess what? If you can now take 8% on the $1.3 million versus 4% on the $2 million, you're still going to have more money in the end. You're still going to be able to take more income. And so this was a really eye-opening study for a lot of people, and it really confirmed, from a mainstream third-party source, what all of the people in academia have been saying for the last 3 decades, and that's that cash value life insurance and annuities can help maximize income at a period in your life when it matters most, and that's when you're retired.
And I'm going to throw out a comment that's kind of half baked, so don't hope I don't get too crucified by this. But some thoughts that I've also had is there's no insurability, there's no health related insurability aspect of a 401k, right? You can contribute to a 401k whether you're in great shape, bad shape, whether you have different health conditions. There is a health aspect of life insurance. In my opinion, I think that's probably should be started at the earlier part of someone's retirement planning. I think that, again, I think it probably should be done in the beginning, not towards the end, right? And I do understand the company match aspect of it, but I think it's also, if someone's making a lower income, pay the tax rates now, put the money into cash value life insurance. If you can't afford it, get term life insurance with some really broad conversion rights. I don't want to go too far down a product rabbit hole here, but that's just something I always want to throw in to think, hey, we always think we're going to be in great shape. Trust me, it's against you. It gets tougher to stay in shape as you get older. You don't have those limitations on a 401k. But I want to go back to some of the Roth conversion stuff that you had mentioned earlier in the show also. Let's talk about, Roth conversions. It's a huge part of what we think people should do. But are there any potential Roth conversion mistakes that people could make, and how do they avoid them?
Well, one potential Roth conversion mistake is to listening to what Dave Ramsey tells you about Roth conversions. Now, I am encouraged that Dave Ramsey seems to have sort of jumped on and I don't want this to be about Dave Ramsey, but I was just reading Dr. Wade Pfau is writing the foreword for my new book, the Guru Gap, and he just sent me the foreword, and I was just reading one of the things that he wrote in there. And Dave Ramsey talks about, by the way, I was saying that I really am heartened that Dave Ramsey has jumped on the tax-free wagon. It hasn't always been the same. Susie Orman has also jumped on the tax-free wagon. She even said, look, tax rates are going to skyrocket in the next 10 years. Why would you not do tax-free? So it's almost like Everybody gets it. Everybody gets it that tax rates in the future. I mean, years ago, I was the lone man in the wilderness trying to get this message out. But to Dave Ramsey's credit, he has jumped on the Roth conversion bandwagon. But he says some things on his website that are actually a bit troubling. One of which is if you're within 5 years of retirement, meaning you're planning on retiring at 60 and you're 55 or older, or maybe even in retirement, you should not consider a Roth conversion. And his reason for doing so is a little strange. He says there's this 5-year Roth conversion rule, which has nothing to do with whether you should do a Roth conversion or not. I talk about this in my book. So, one of the reasons that's not an appropriate recommendation is that your retirement years, you could be in a much lower tax bracket than you are today. And it's a great time to do, particularly if that happens in the next 8 years, you could be in a lower tax bracket then than you are right now because you're not earning quite as large an income. So that math there doesn't really add up. Then another thing he says is you should only do a Roth conversion if you have money outside of the IRA with which to pay the tax. Well, I don't know about you and your clients, but I've been doing this for 25 years and I can tell you that very, very few people have enough money in their taxable bucket that they can use to earmark towards paying all of the tax on a huge Roth conversion. They just don't have it. So under that rule, under that guidance, no one would ever do a Roth conversion. They just have to leave their $2 million sitting on the train tracks with the tax freight train bearing down on it, and they got to watch helplessly as the tax freight train, smashes it to smithereens. I mean, it's just, this is the problem with some of these mainstream financial gurus who haven't marinated in correct financial principles for as long as maybe you and I have. They're preaching one size fits all, paint by the number, black and white, unnuanced advice that people are supposed to take and somehow apply to their own situation. Well, that's not how it works in real life. People are looking for customized, tailored strategies that can help them wring the most efficiency out of their retirement savings. And that's not what they're getting from gurus. And that's probably why I've trained my rhetorical canon on gurus so much in the last year or so, because I feel like the message is getting really muddied and people aren't getting the right advice. Particularly the sophisticated investor who's, like I said, done a good job of saving, played by the rules, and now just looking to enjoy a sustainable retirement. So that's really why I focus so much on it of late.
And I hope this isn't redundant, but is there any real kind of sweet spot for Roth conversions, for IRAs?
Yeah, in my book, The Power Zero, all of chapter 6 is it's actually entitled The Tax Sale of a Lifetime. When I updated and revised it, when Penguin Random House bought the book back in 2018, I added a chapter 6 that was perfect timing because it was right when the Tax Cut and Jobs Act went into force. So you now have this 8-year period of time during which to take advantage of historically low tax rates. And I talk about how the 24% tax bracket is the sweet spot in the Trump tax cuts. Why? Well, if I were to tell you, Christopher, that, hey, tax rates are going to double down the road in an effort to protect your hard-earned retirement savings from the impact of higher taxes, you, who are currently in say a 12% tax bracket, you need to bump up into a 22% tax bracket in order to get all that converting done to get you to tax-free by the time you retire. Well, how would you feel about that? Probably not very good. Because in an effort to help you avoid a doubling of tax rates over time, I doubled your tax bracket in the short term. Doesn't feel very good. Doesn't feel like a very sound recommendation. However, if you're currently in the 22% tax bracket, and I said to avoid a doubling of tax rates over time, let's convert to the top of the 22. By the way, the 24% tax bracket is only 2% more, but it allows you to convert an extra $173,000 or so to tax-free, and it only costs you 2% more on the margin. Well, all of a sudden that recommendation is going to go down a little bit easier. And by the way, when I ask clients, how often do you think clients where I say, hey, look, are you okay if we bump up to the 24% tax bracket? It's only 2% more, and we can get that entire $1 million shifted to tax-free along the way by utilizing the 24. How often do you think they love that recommendation? Pretty much 100% of the time. So that's the sweet spot. That's why I think it's important to take advantage of these next 2 years. And again, it's not the end of the world if you don't get everything shifted over, because still, the future version of the 22 is 25, future version of the 24 is 28. That's still better than 32. So don't bump into the 32 in the meantime. stretch that tax obligation out over a couple of different years.
Yeah. Yeah. And I kind of inadvertently mentioned IRAs. I meant to say, IRS tax code, and I mentioned IRAs. But when I think of IRAs, who do we think of, right? And while we're mentioning other folks in all good lights, if I said IRA, who do you think of?
I think of Ed Slott.
That's right. I mean, he is the IRA,
Expert.
I would
Yeah.
say, person, right?
Yep.
I because I love all things insurance, and I just can't help but go on webinars all the time. I happen to listen to one of his, and he because of the Secure Act 2.0, which kind of came out a couple of years ago, the IRA, the individual retirement account, I believe, and I could be paraphrasing this a little incorrectly, but I think he said it went from the best account to the worst account from a legacy standpoint, right? And he now says that life insurance is one of the single greatest benefits in the tax code. Why would he say such a thing?
Well, number one, there's no limit on how much you can put in there, really. I mean, I guess you could make the case that you're constrained by how much death benefit that the company will give you, but for all intents and purposes, you can put as much money as you want into these programs. So you look at a Roth IRA, you can put in 8,000 per year if you're over age 50, and your spouse can do the same. Roth 401k, you can put in 30,500. Your spouse can do the same if you're over age 50. Yeah, I got clients that put 200,000 per year into their cash value life insurance. So there's no limit on how much you put in. And what Ed is referring to is it used to be that you could use trusts to determine the cadence with which money got distributed from your retirement accounts after you died. You can no longer do that. So the only thing you can really do if you really want to control how that money gets meted out after you die is to put that money into a life insurance policy, the beneficiary of which is a trust, right? And that trust, once that money, once you die and that money goes into the trust, then the trust can then determine the cadence with which the money gets distributed to your heirs. And so Ed Slott loved life insurance before the Secure Act, but he loves it even more now because it now has replaced it's really the only way to be able to rule from the grave and determine the cadence with which your children receive. Because right now, the way things currently stand, they're going to get it all at once, and they've got 10 years to spend it down, right?
Right.
And
Inherited IRAs, correct?
yeah, and what's going to happen? Most people are going to spend it in the first 18 months. So they inherit $1 million, they spend in the first 18 months. What happens to their tax bracket? They're going to shoot to the top of their tax bracket, spend most of that money in those first 2 years, and most of that money is going to be taxed on top of their current ordinary income, which means it's going to be taxed at some of these higher marginal tax brackets. So guess what? You had $1 million you wanted to go to your heirs, and they only really get to spend about 500, 600,000 of it. So there's a lot of tools in place to be able to ensure that money gets distributed in the most efficient way. And really the most prominent crown jewel is cash value life insurance. And Ed Slott's right. It is the single greatest benefit in the IRS tax code.
And I do find it refreshing. Also, as Ed Slott's talking about this, he will say, "I am not licensed to sell life insurance. I do not sell life insurance, but I absolutely love life insurance for what it can do with regard to the tax code." And then when we're talking about other, different kind of like nooks and crannies in the tax code, that Americans should be taking advantage of, when it comes to a balanced approach to tax-free retirement. Are there any other things that people should be looking into to be proactive, right, about this?
Yeah, I mean, there's 6 different streams of tax. I always advocate, look, you don't want to put all your eggs in one basket. You want to have multiple streams of tax-free income, none of which show up on the IRS's radar, but all of which contribute to you being at or near the 0% tax bracket in retirement. So what are the different nooks and crannies in the IRS tax code? You've got Roth IRAs. Those are great because they're tax-free, but you also have liquidity on the money if you need to take the money out. You've got Roth 401ks. Those are great because you can put in up to 30,500 if you're over age 50, and you get a company match. That's great. Free money is always going to increase the return on your investment. You got Roth conversions. I love Roth conversions because there's no limit on how much you can convert. When you're trying to get to the 0% tax bracket, the Roth conversion is a real workhorse in making that all happen. I love cash value life insurance. particularly because in many instances, depending on the company, you can get a death benefit that doubles as long-term care. You can get the death benefit in advance of your death for the purpose of paying for long-term care. Nothing else is going to do that for you. I love, this is my favorite. I call this the holy grail of financial planning. I love taking money out of your IRAs tax-free. How do you do that? Well, if you can make sure through Roth conversions that you whittle your IRA balance down to an amount that's low enough such that your required minimum distributions are equal to or less than your standard deduction, guess what? Those RMDs are going to be tax-free, okay? And so that's 5. And if you can keep your provisional income low enough, by the way, provisional income is the income the IRS tracks to determine if they're going to tax your Social Security. If you can keep that provisional income low enough, then your Social Security will also be tax-free. So if you have tax-free, 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 what tax bracket does that put you in? 0%. I love 0 because if tax rates double, 2 times 0 is still 0.
And hopefully Social Security is still around in its current form in the next 20 to 40 years, whenever I might need it, or hopefully still around. It is basically an inflation adjusted annuity. Would you agree?
Yeah. I mean, Social Security is great in its current form. It's great. I mean, it's
Yeah.
like a pension. It's and it can help you mitigate a lot of risks. I mean, it can help you mitigate inflation risk, obviously, because it's linked to inflation. It can help you mitigate long-term care risk because it can be utilized to pay for long-term care. It can help mitigate sequence of return risk because you're not having to dip as deeply into your stock market portfolio. When the stock market goes down, you can live off of your Social Security. So it's just, Social Security is a great benefit. I hope it sticks around in its current state. But as you mentioned, it's got some real challenges coming up. I know that by 2034, it's going to experience, and if nothing else happens, it'll experience a 22% cut across the board. I don't think that's going to happen. I think they're going to raise taxes to help compensate for it.
I agree. And as we get closer to landing the plane here, I do want to spend a little bit of time on something that you've kind of already mentioned that I want to just emphasize is long-term care, and how does it factor into retirement risk? I probably, like you and a lot of others, have a personal story that relates to long-term care and extended care. I just want to kind of drill down a little bit on the importance of factoring it into any planning strategy, right? And utilizing either cash value life insurance, permanent life insurance, or if there's a health condition, maybe even using an annuity to tack on long-term care. Talk to us a little bit about that, and what are some thoughts, or what are some things that you might propose to clients and prospective clients?
So when I'm sitting across the table from a client, I always have the following discussion. I'll say, Mr. Jones, I always talk to the husband first. I say, Mr. Jones, you know I love you, right? He goes, yeah, Dave, I know you love me. I'd say, I do love you, but you're better off dying than needing long-term care. And he'll look a little sort of taken back. And I'll say, why is that? I'll say, well, at least if you die, then Mrs. Jones here would be beneficiary on all of your investment accounts. And while we would miss you terribly, life for her is going to go along relatively unchanged. I say, however, if you didn't die and you ended up needing long-term care, now all of a sudden, what does she get to keep? She gets to keep 1 house, 1 car, a minimum monthly maintenance needs allowance of about $2,500 a month, about $130,000 of cash, depending on the state. So what was shaping up to be a perfectly rosy retirement for Mrs. Jones here turns into basic, bare bones, subsistence type living. Of course, the converse holds true if Mrs. Jones should end up needing long-term care. So it's a big deal. I mean, you could be perfectly set up for a great retirement, and then somebody ends up almost dying and needing long-term care for the next 10 years. So you burn through a lifetime worth of savings in just a few short years. And so people aren't opposed to having long-term care insurance. They're just opposed to paying for it. I tell people all the time, hey, if you can have a cash value life insurance that allows you to spend the death benefit in advance of your death for the purpose of paying for long-term care, then you don't have quite that same sting. Why? Because if you die peacefully in your sleep 30 years from now, never having needed long-term care, someone's still getting a death benefit, probably your kids or your grandkids. I've realized I used to say just kids, but now I realize most people don't want to give money necessarily just to their kids. They want to give it to their grandkids. So there isn't that sensation of having paid for something you hope you never have to use. And traditional long-term care insurance gives people a lot of heartburn. It's expensive, it's hard to qualify for, and it's use it or lose it. And
Right.
cash value life insurance seems to resolve all of those because your cash value grows. You can access that cash value in the meantime, and if you do end up needing long-term care, you can spend the death benefit down while you're alive. And if you die peaceful in your sleep, never having needed long-term care, someone's gonna still get that death benefit.
Yeah. And I mean, if you just look at the numbers, you look at the data, and really the question, the need is there. I don't think anybody disagrees. I think the question is really, how do you want to finance it? How do you want to fund the eventual care? Right. And depending on if it's the man or woman, right, the tenure of the care, the longevity, right? It could be somewhere between 3 to 5 years for males, and 5, I think, to 7 or 8 for females, right? And those 5, they're very expensive. And I don't think a lot of people have that factored into their planning. I think there's a lot of landmines. I'm of the opinion that something is better than nothing, right? If you know, if a standalone is all you can afford, standalone's better than nothing. And this also kind of takes me back, and I want to be very clear. The need is more important than anything else, but I do want to highlight when we talk about, I mentioned the state income taxes earlier, and you talk about Medicare. This is having a significant effect on state budgets. And what we're starting to see, and this kind of deviates a little bit from what we're talking about, but you're starting to see legislation or talks of legislation, proposed legislation in various states, right? We saw it in the state of Washington, where they created a publicly funded or a payroll tax funded public long-term care program, the Washington Cares program, right? They rushed it a little bit. It's not without its faults. It's getting tweaked. But what we're seeing is other states starting to follow suit because they understand, they've done the math. It's going to be problematic. So another reason why I would recommend to people start addressing this now, because for those high income earners, right, if we use the state of Washington as a kind of a benchmark, where they said if you don't have a long-term care policy, you're going to have a 58 basis point payroll tax with no cap. High income earners, that's pretty significant in the state of Washington. Now, I don't have kind of the updated map here on my screen, but I think we've seen now the state of California has gone to a task force, and they have nothing imminent. Just want to be clear, but they're looking at legislation. You're seeing it in New York. You're seeing it in Connecticut, North Carolina, Maryland, Minnesota. All over are now starting to look at implementing publicly funded programs via payroll taxes. So it's just another reason that people need to be proactive, not to kind of steal away from what we talked about, but this is now starting to affect not just the federal, but the state budgets also.
Yeah, no doubt. And that's been in the works for a while. And I think that these states are waking up to this idea that there's this titanic expense that's looming off in the horizon. And they're actually doing what the federal government should be doing. And the reason they're doing it is because states don't have the ability to print money like the federal government does. So they don't have any recourse if they don't sort of anticipate these types of expenditures. So I think that they're doing the prudent thing, which is anticipating the types of fiscal constraints that they're going to be having years down the road. So I think it's smart that they're addressing it now. I just wish the federal government would follow suit.
Well, hopefully they watch the replay of this show. But before we end, and you've talked about it a little bit, I do want to hear a little bit about the next book. Talk to us about that. Talk to us about when it's going to hit the bookshelves, and when Chris Martens can get his next David McKnight book.
Should be launching sometime in the fall. I imagine it'll be available for pre-order sometime in the next month. It's called The Guru Gap, how America's financial gurus are leading you astray and how to get back on track. And the thing that I try to really be clear about in this book is that, look, I think that Dave Ramsey and Suze Orman have done an incredible service for a lot of America. I mean,
Agreed.
I've heard story after story after story of people who are mired down in debt, and they adopt the Dave Ramsey or the Suze Orman approach, and it's really turned their lives around. And I think that they're to be commended for their outsized impact on America. but I also think they should stay in their lane. I mean, Dave Ramsey's very good at getting you out of debt, but he's not all that good at helping you stay rich once he helps you build that nest egg. And so part of the problem with gurus is that they're trying to appeal to as broad an audience as possible. And to do that, they have to dispense advice where when you listen to it, you're like, man, Dave is speaking to me. Susie is speaking to me. It's got to be sufficiently broad, sufficiently, undetailed that you can think, oh, now all I got to do is listen to Dave and I'll have a roadmap for financial success. The problem is that's not how it really works in the real world. Everybody is different. Everybody requires different strategy. And Dave Ramsey and Susie Orman, they don't have the luxury of nuance. They have to couch these financial principles in really broad terms. And for people who've done a good job of saving and they're disciplined investors, they're not well served by this type of advice. They need advice that is it's tailored to their specific situation. And unfortunately, because of this really broad, unnuanced approach, they can't stand behind financial products that require nuance. So I give you an example. Dave Ramsey can't say permanent life insurance works great in scenario A, B, and C, but not in D, E, and F. Because if he started making distinctions like that, then people would be like, well, Dave Ramsey's not really capable of giving me the type of advice I need. Maybe I need a financial advisor, right? Dave Ramsey isn't well served by doing that. His empire is not going to expand if he starts saying you need nuanced advice. Now, does Dave Ramsey have his SmartVestor Pro advisors? Yes. But unless they parrot exactly what Dave Ramsey says, they get excommunicated from the program. And what does Dave Ramsey say? No permanent life insurance and no annuities, which are precisely the types of things that people like Wade Pfau have done study after study after study that show that you are going to spend more money in retirement if you utilize these types of tools. And so I go through, talk about Dave Ramsey, Susie Orman, Clark Howard, Ramit Sethi. I spend a whole chapter talking about our friend Ken Fisher, who says, I hate annuities and so should you. I debunk his video where he talks about, he says, I'd rather go to hell than sell you an annuity, and he gives 8 reasons why. I go through all of those 8 reasons. I debunk every single one of those. And I talk about how, Ken Fisher has a motivation for getting you to hate annuities, because if you don't have money locked away in annuities, you can roll your money over to Fisher Investments, where he gets to earn 1.5 points over the course of the rest of your retirement. So everybody has financial motivations. I try to parse through what those are a little bit, but really at the end of the day, I'm really trying to get at what those sustainable retirement strategies are. How can people wring the most efficiency out of their retirement plan? And 9 times out of 10, it's not by implementing advice that's dispensed by these famous one-size-fits-all financial gurus.
And I think it's pretty safe to say, aside from what you just said, people should probably not take advice from people on TikTok. Would you agree?
Yes. I've spilled a lot of ink over people on TikTok, particularly those who think that, for example, IUL is the silver bullet. I mean, I love IUL, but it's got to be used, in a measured way as a complement to all of these other tax-free streams of income that we talk about. When people say, for example, an IUL is so much better than a Roth IRA, and here's why. I say that's a losing message. That's a one-size-fits-all message. You're gonna start sounding like gurus at this point. IULs only really work when used in concert with Roth IRAs, Roth 401ks, Roth conversions, taking money out of IRAs up to standard deductions, so on and so forth. So TikTok's not my favorite place to get financial advice. I think that America deserves a balanced approach to tax-free retirement. There's a problem, and that's that tax rates are going up. What's the best way to shield yourself? Those are the types of principles we talk about in this book.
Dave, I absolutely love it. I cannot thank you enough. As I stated in the beginning, having you on as a guest was personally and professionally important to me, to my family, and thank you for coming on. We ripped through an hour here pretty quickly. We could probably keep going for hours. We won't do that. I won't do that to you. But thank you again. And if you want to just kind of talk about, give the people the website address for you. If you want to shoot that out again, please go ahead. But David, thank you again. I can't thank you enough.
My pleasure. If people want to learn more about me, they can go to davemcknight.com. If they want to learn about how to become even a Power Zero advisor, you can go to powerzero.com. And of course, my YouTube channel is the Power Zero.
Awesome. Thank you again. And thank you guys for coming to the Proactive Risk Management for the C-Suite webinar series. We'll see you guys in a month. Thanks, guys.